Retail risk management typically involves a subjective dollar amount to a trade after the position is already open. Placing a static stop-loss based on personal comfort rather than market structure creates a disconnect between the trader's account and the actual price action. Institutional algorithms are programmed to identify these clusters of retail orders. These systems sweep through non-structural liquidity to find the counterparties needed for larger positions. This specific moment demonstrates the failure of the arbitrary model. Price action spikes through the horizontal stop-loss level, triggering the exit order just before the market resumes its original direction. Risk models that rely on personal preference often fail in high-frequency environments because they lack a basis in market physics. An alternative approach requires risk to be a built-in property of the market's own wave geometry. This endogenous risk model requires the market structure to establish a clear level of support or resistance before a trade is ever executed. In this system, the geometry of the setup defines the specific boundaries of the trade. Ultimately, the wave geometry functions as the risk management system itself, providing the technical parameters for every position. We can build this model by first observing how institutional intent creates a measurable imbalance in price. This initial surge, wave A, marks the arrival of institutional torque. This aggressive vector represents a break in market balance, as high volume drives price in a specific direction. Following this surge, the price undergoes a controlled pullback. This is wave B. During this phase, volume dries up and momentum decays, indicating that the initial aggressive buying or selling has stabilized. While wave A shows us the intended direction, wave B provides the structural pivot required to define a stop-loss level. The low point established by the wave B pullback serves as a technical anchor. This horizontal beam represents the absolute invalidation floor for the trade. This line serves as the objective boundary for the trade, identifying the exact price where the current trend logic is no longer valid. If price returns to breach this B-wave floor, the structural physics of the trend are negated. The thesis for a continuation is dead. Using this boundary eliminates the need for subjective stop placement by identifying the level where the price cycle ends. Applying this principle across multiple timeframes creates a layered structure of support. The split screen compares a 4-hour macro chart with a 1-minute execution chart. The macro chart provides the overall gravity of the workspace. On the 1-minute chart, we wait for a miniature ABC sequence to form in the same direction as the macro trend. The 4-hour structure provides a significant profit target, or upside runway, based on macro liquidity levels. However, the risk is tied strictly to the micro B-wave floor on the 1-minute chart. This nested C-wave creates a state where the potential profit is measured in macro points, but the potential loss is measured in micro ticks. This asymmetry allows a trader to increase position size while maintaining the same dollar risk, since the structural stop-loss is extremely tight. The architecture also functions as a filter, preventing the execution of low-probability trades. In an A-wave state, price is moving vertically with no established pullback. Chasing this vertical price action is a common error. The system flags this as an illegal entry. Without a B-wave pullback, there is no structural floor to anchor a stop-loss. This makes the risk incalculable. As price approaches major macro resistance, it enters an exhausted state. Here, the distance to the nearest support floor is large, while the remaining room for price to move upward is small. This geometry creates a negative expectancy. The trader is forced to risk a large amount of capital to capture a small remaining move. The wave structure acts as a mechanical governor, identifying these environments and preventing trade execution before capital is deployed. Combining these concepts, intent, invalidation levels, and multi-timeframe nesting, creates a cohesive technical framework. When these structural rules are applied together, they form a systematic, ironclad defense for the trader's account against market volatility. Technical proficiency focuses on identifying structures with specific, calculable invalidation points. These points allow for the systematic management of risk in an otherwise chaotic environment. By relying on the objective geometry of the wave, a trader can manage capital with a clear structural definition of failure.